Now, so how is it we are up $2,800 and actually have a realized profit of over $1,150 and still lost over $2,000 by the end of the day? Let's first talk about the profit because that's the easiest part to cover, right? So the profit came from actually closing the rest of my SQQQ hedge, and overall we basically made about 70% from that position. We invested a total of $610, and then by the time we sold everything, the total amount that we received back was $1,020 lah. Right. We also made money because we actually bought PayPal at $59.19. After earnings, PayPal actually did well in their earnings, and it went all the way up to $66, $67 at the start of Thursday. And so far, actually, also have good earnings. It was flattish, slightly up after earnings, which is crazy, especially seeing how good their earnings are. And I'm really going to dive in deep into why this is such a high conviction play for me sometime next week. Look here, you can actually see we have quite a lot of cash as collateral, about 13,000. Actually, once this trade goes through the SQQQ and it's registered, I should have over $14,000 of cash. But this $14,000 in cash is basically not just idle money. It's actually there for collateral for us to sell puts against. So basically that's what we are using it for, and I'll explain it a little bit more later on in the video. But before that, let me just set the context. You see, before this happened, what I wanted to do was talk about the earnings that actually just went past in the past week, and then also talk a little bit about the FOMC meeting so that you have a general idea of where my head is at going into the weeks ahead. Now the plan is I'm going to talk about earnings in a totally separate video, and we're just going to focus on how we are going to work through this situation. Let me give you a high level overview of basically what's happening here. Now, basically if you look at earnings, right? If you look at Google and Tesla's earnings 2 weeks ago, Tesla's earnings were not too bad. Google's earnings were actually quite good, and they actually say AI made businesses profitable, but how much of a revenue driver AI is going to be remains to be seen. So that is why the market fell. They also spent a lot more on capex, which I guess worried the markets, and that is when I actually put on this SQQQ hedge, right? But then earlier on this week, Microsoft and AMD had actually pretty decent earnings, actually pretty good earnings, so that's a yay, you know. And then on Wednesday, Meta had good earnings as well. And combine that with actually how dovish Powell sounded during the FOMC meeting, which is basically what made me want to take off my SQQQ hedge. Because during the meeting, Powell actually basically just confirmed that, you know, if everything is going to continue as it is today, then September there will be rate cuts. He even built in an excuse in case 1 or 2 data points in the coming months, right, come in below expectations. He practically said that, you know, we are data dependent, not data point dependent. So he's basically giving himself an excuse that even if 1 or 2 things don't go according to plan, they can still cut in September, and he doesn't have to go back on his words. So we are all trending in the right direction, and that's basically why I actually moved to remove my hedges from the stock market. That's basically where we find ourselves at, right? Pretty decent earnings, not fantastic, but not too bad earnings from most companies. And at the same time, we have a dovish Powell during the FOMC, so I removed my hedges. And so one of the things I realized, right, over the last couple of videos, right, is that people are not so interested in such a deep analysis of each different companies during this kind of portfolio update. You just want to know what is happening in the portfolio update. So I will keep those company-specific videos separate from these portfolio videos from now on, and I'll just give you a high-level overview of what's happening in the portfolio. So if you like this idea, do take the time to hit the like and subscribe. Thank you very much, and back to the video. And all this started because I went against my better judgment. And so if you haven't realized by now, the company that we are talking about is Intel. Now, Intel is what we will usually term a turnaround play, which means a company that has been mismanaged or basically been adversely affected by macroeconomic conditions, and then they're basically not performing very well over the last couple of years. And then what happens is that the company has undergone some restructuring such that it's actually moving on into a new phase of business, but then the market hasn't really caught on to the news yet, haven't really fully valued the company, and what we're doing is trying to get in early before other people realize that, hey, actually this company is not totally dead. So the idea is that when people realize that this company is not dead, there is still room for growth moving forward, then the company's price will rise and basically will benefit from basically entering into this trade early. This is actually quite common, right? A lot of people did that with Meta at $88 all the way to $500, or even Google at $90 to $180. More recently, we have also done it with Enphase, knowing that we actually want to buy Enphase between 95 and 105. And basically we actually sold a put on that, and the reason was very simply because we knew that there was nothing wrong with Enphase business, their technology, nothing was wrong with it. The only problem with their company, why the revenues were so adversely affected, was because of macro conditions. They do not do well in high rate environments, which is basically what we had. So I was okay to open a position with Enphase as rates started to come down. The second company we actually did a turnaround play on is basically PayPal. I wouldn't say PayPal is clearly out into the woods yet, neither would I say Enphase is clearly out into the woods, but we can actually see some signs of life. Especially in PayPal's case, the new management has been doing well. The previous management really mismanaged the company. They went for revenue growth and basically sacrificed margin in the process. And so what the new management has did is to basically reverse that, start to make PayPal into a more efficient business, and we can actually start to see that in the last quarter, which is why the share price actually rose so much after the last earnings call. But unfortunately, in our case, for Intel, that did not happen. In fact, after the earnings call, right, they dropped a total of 20%, and we'll explore why in a bit. Yes, you heard me correct. They fell 20% after after the earnings call, 20%. And so you see, the initial plan was to tell you how, with the dovish FOMC, with the earnings that we actually heard over the past week, right? It doesn't mean that we're out in the clear and then we are definitely going on a bullish run moving forward all the way up to the election and beyond. But actually to be a little bit cautious in our approach to the market. But this happened. I'm basically stuck having to manage this position, and I want to take this chance to basically talk about two things that I learned about investing over the years when it comes to situations like this. And the first one is understanding turnaround plays. New beginning investors or people who do not have so much time to look into individual companies, right, should not be targeting turnaround plays. And you want to make a turnaround play or to invest in a turnaround play, basically you really, really need to put in the time to understand the business, to understand the changes that they are taking to basically restructure the business and to see whether or not these things actually have a material impact on how the business is run moving forward. Without understanding that, right, turnaround plays can be quite risky. So I've been stuck in bad turnaround plays. I've also had experiences with good turnaround plays. So good turnaround plays will be things like people misunderstanding Palantir, people misunderstanding Google and things like that. So-called bad turnaround plays are possibly things like Alibaba. Alibaba was something I found myself caught in. I bought in the 160s. In the end, I had to decide to take a loss and sell in the 120 so that I can reinvest into companies like Google and Palantir. Otherwise, all this will be basically opportunity cost, capital that is going to be stuck there, not doing anything. And I'm quite thankful I did that because today Alibaba is still in the 70s. But again, that's not to say Alibaba is a bad company. I like it. I will start investing in it when the macro environment in China starts to change. So in general, for the beginning investors, for retail investors that maybe do not have so much time, don't focus on turnaround plays. Look for companies with strong fundamentals. They don't need to turn around. They just need to continue performing the way that they are doing, basically generating a lot of cash flow for you, and your investment will be fine. However, sometimes we do find ourselves stuck in these kind of positions, and I'm going to talk to you about how to manage these kind of positions. But first, I want to talk you through my thought process on why I started investing in Intel this year. Now, actually, the turnaround for Intel started back in 2021 when Pat Gelsinger came back. His plan was basically to build Intel into a semiconductor foundry, and basically just for the layman, right? Because there are a lot of these semiconductor companies out there. Many of them, what they do is they actually design the chip and then they get someone else to manufacture the chip. So basically what Intel are trying to do is that they're trying to design a chip and have a manufacturing arm as well. So basically they want to compete with companies like TSMC. Wanting to manufacture chips, right, is a very capital intensive build out. It means that they take a lot of money to build out the facilities that they need to be able to manufacture chips. So I knew that this was going to affect their financials and the markets will not like it. And I think the stock price basically reflected that over the last couple of years. So this is unlike PayPal, because PayPal was a software company, right? So a turnaround of a manufacturing company cannot be compared to a turnaround of a software company. The turnaround of a manufacturing usually takes much longer because of the amount of capital expenditure that is involved. So why they interest me now, right, is because they have been quietly getting to the work done behind the scenes. Not that they're doing anything groundbreaking like Nvidia and things like that. Not that I'm not even suggesting that they can catch up with Nvidia just by doing what they are doing, but they are at least releasing competitive products, right? So they are largely able to meet the milestones that they have set out for their 5 nodes in 4 years plan, and basically they're coming to the tail end of this investment cycle already. So I believe that basically coming into these earnings, I actually expected them to have poor earnings, but I actually thought that, oh, you know what, no matter how bad earnings are, maybe 1-2 quarters of bad earnings already, right, we'll start to see the fruits of their labor. And it's basically in 2025 that if we don't see any improvements in terms of revenue and profitability, then we can start to question the management. And so that was the idea going into this investment. So if we talk about the options that we actually sold on Intel, we actually sold 5 options at a $29 strike at $1.40 premium, which is about a 4.8% yield. So I sold 5 cash secured puts. And to be frank, I really expected Intel's earnings to be bad, which is why if I had to buy shares at the average of $27.60, I'm actually quite good. So for context, right, when I sold this put, this was probably about $30 or slightly above $30 to get this pricing. So I gave myself about a 10% margin in case they had bad earnings and earnings crept a bit. But basically because the share prices, basically the whole market crashed yesterday, so that actually wiped out half of my margin of safety. And the thing is, right, when they released their earnings, right, it was poor just as I expected. And actually the thing is, right, they actually came up with this $10 billion cost reduction plan where they actually unfortunately have to fire about 15% of their staff. They basically restructure their business from the inside so that they remove about $10 billion worth of excess expenditure in terms of like capital expenditure and operating expenses and things like that. So I actually believe, right, if the market reaction to these poor earnings will not be so drastic because of this 10 billion of cost reduction moving forward. But the problem is they actually reduced their dividend back to zero. So basically they cut their dividend. Now in all fairness, right, I don't even think Intel is in a position to be giving out a dividend in the first place. So I'm actually quite glad that they cut the dividend and actually keep the money to basically spend to reinvest into the company, because right now the most important thing for Intel is to come up with good products and processors that are actually competitive in the market, because it can't be, right, AI is growing. growing, cloud computing is growing, and more people are needing compute, but yet you're still losing market share. But I think because of the poor earnings and plus the dividend cut, the stock actually fell 20%. So which means, right, if you include the intrinsic value of the stock price falling to about $23 where it is today, I would say that when the market opened, each of these contracts that I sold at 140 should be worth about $7.40. So what does that mean? This means that today I receive a total of about $700 in premium. However, if tomorrow I want to close out these option contracts, I need to pay back $3,700. I say again, I receive $700 or so in premium today on Thursday, but then if I want to close that out tomorrow on Friday at market open, I probably have to pay back about $3,700. So we are down somewhere about $2,930 on this investment, which brings me to my second talking point, which is basically how I think about options that are in this position, that are under pressure, that are under the water. I think the first and most important thing when your positions are underwater, right, is not to panic. Basically, what you need to do is actually to come up with a plan before market open. So basically, I wrote down 3 possible scenarios that are going to happen, and I'm going to take you through each one of them. And then I'm going to see how the market plays out at the start. I may or may not make any moves tomorrow. That means on Friday. I may wait until Monday and then we see how that goes. So basically, the first option is to hold steady and wait. So what this means is that because you see I actually have the $14,000 in collateral in my account, right? So I will just let the $14,500 be assigned. So I'll buy $14,500 worth of Intel shares. I received the $700 premium. So that means net I actually spent about $13,800 to buy these shares at a $27.60 cost basis. So what I'm going to do is then I will sell covered costs $3 out from whatever price it is at that point in time for about 50 cents and collect another premium of $250. Now, how I actually get these numbers, right, you actually have to look at the options market, which is not basically the whole idea of this video, but this is just to give you an idea of my thought process. So the first option is to let the shares get assigned, right, keep the premium, and then go and sell a covered call on it until the shares get called away, and then basically reducing my cost basis in the meantime. So by doing that, basically what happens is I collect the $700 premium, sell the covered call, collect another $250 premium, and at the end, I will own about 500 Intel shares at a cost basis of $27. So even if it's at about $23, $24, it's not that far off. Moving forward, what I can do in that case is just to keep selling covered calls until the shares get called away and until this position basically turns profitable. So that's the first option. Second option is basically to close the 5 cash secured puts. Basically, that means, like I said, I received $700. Now I go to pay $3,700 to close. Take a loss of $2,996, right? And then I may want to look to sell a $26 put for 18th of October, $7.70. Now, why 18th of October, right? Is because the third quarter will have passed, and if you listen to the earnings call, right, they actually say that they actually reset the company on a financial basis this year, in this quarter. That's why they did so much cost cutting and things like that, and that moving forward, they are going to grow revenues from here on forward. So by selling the $26 put on 18th of October, I'm giving myself the whole Q3 as a runway for them to execute and then to basically reassess at the next earnings. So when I do that, right, okay, I take a loss of $2,996, but when I sell the $26 put on 18th October for about $770, based on the options pricing that I'm estimating, I will collect a premium of $3,850. Okay, so if you think about the math, right, basically I receive $700 and slight $704. Okay, I pay back $3,700. So now I'm down $2,996. I collect a premium of $3,850. So that means there's a net gain of about $150. Now, you can't say that, my premium is actually $3,850, because part of that is actually to make up for the loss that I already have, right? So the net gain is actually only $150, which means the total premium I actually receive is the initial $704 plus this $150. However, the benefits of this is that I lessen the amount of collateral I need, because initially I'm promising to buy Intel at $29. Now I'm only promising it to buy at $26. And then in terms of the yield, basically I get about $854 in premium. That is about 2.6 monthly yield, so which is not too bad, because usually I try and aim about 2 to 3%, so 2.6 is not too bad. Initially it was much better, right? 4.8% yield, but considering the situation now, having a 2.6% yield is not too bad. And so that is basically the option that I'm actually leaning towards. There's a third option, which is basically out of these 5, I can close part of it so that I take some of the loss and not a full loss, maybe 2 or 3 contracts. And then basically what I do is free up this collateral, and then I go and sell a cash secured put on another company that I actually have higher conviction in, things like SoFi and Palantir lah. So that's another thing I'm considering. However, because the volatility is different from different companies, I may not be able to get a good options pricing. So this one is really situation dependent. Like I said, when market opens, then we'll have to see. Because going forward, I'm a bit concerned that the market is going to be a little bit volatile. So I do want to be a little bit more cautious in terms of my pricings for my options contracts lah. So that is something really I will have to take a look once the market opens. If you find yourself in this position, you need to hit the like and subscribe button so that you can learn how to manage your portfolio when things like that happen. Thank you, and back to the video. And so you see here on this channel, we are dedicated to provide you transparency, which is basically what I felt was lacking when I first started investing, because nobody wanted to show how much they actually made or lose in the market. Everybody kind of wanted to show, how well they do. Everybody's a millionaire, everybody's driving Lamborghinis and things like that. And you see, the thing is, whether intentionally or unintentionally or because of a lack of knowledge and things like that, sometimes we do find ourselves in the position that you find yourself today. The moment you invest in something, some big unexpected market event happens and you're down heavily in that position, and you really need to start to manage the position. So you can actually see, right, from some of the actions that I plan to take, this $2,000 loss can be mitigated and be reduced to either a small profit or a very small loss. So which is something that I hope that this thought process is something that gives you clarity moving forward. I can speak more about it in detail if you need me to break it down even more for you. But I think, like I said, at the end of the day, if you actually find yourself in this position, I think the first things first is to not get yourself in this position, right? Which is what I said, the first point, which is if you are new to this or you don't have a lot of time, then focus on basically investing in good, strong, fundamentally sound companies that generate a basically crap ton of cash flow. And don't go and try and look for all these turnaround companies, because in terms of research, this is very time intensive. And at the same time, if you actually buy the wrong companies or if you over allocate, then you can, and without using options and things like that, especially, right, then this can be basically sunk cost, an opportunity cost. So the first thing to remember is that not to get yourself in this position. If you are new to this, try not to invest in turnaround companies. The second thing is that when you find yourself in this position, bo pian already, right, you're already stuck in this position, then it's important to keep your emotions in check. And how you do that is basically to set out the plan before the start of market opens, because the moment market opens, you might be shocked at how fast and how quickly the price drops. So basically, you already want to have a plan, and you want to know that if this happens, maybe I'm going to go with option 1. If this happens, I'm going to go with option 2. And so basically, to set the plan beforehand and to basically think it through. Don't be so affected by what's already done. What's done is already done, and that's what it means by having a stomach for volatility. When things like that happen, it's not that you can just sit through it and do nothing. You actually are able to sit down and logically plan out various different ways out of this position, and to basically turn a trade that is maybe not so profitable into a more profitable trade. So which is like what we're doing here lah. So like in either one of our options, in the worst case scenario, we may lose about $100, $200. Best case scenario, we are possibly up a couple $100 lah. So it depends on where we eventually exit this position. And just a quick disclaimer, because I started this whole portfolio with about $15,400, and looking at how the market is moving forward, I might want to move in another $4,600 eventually to basically top up our original capital up to $20,000. The reason for this is because you really don't know how the market is going to be, and we have a lot of open options positions. In case of early assignment in more than one positions, we do not want to be caught in a place where we are actually forced to sell some of our profitable holdings that we want to hold in the long term just to exercise these options contracts. So I want to, I'm actually planning to perhaps inject some capital in, but I will really see how this Intel position plays out first before deciding whether or not to do that, and I'll update you if I do. So I hope my thought process is quite clear here on how I plan to approach this, and if you have any questions, you can leave it down below, and I'll see you in the next one.